Harvard Law School faculty book talk on Missing the Target, Why Stock Market Short-termism is Not a Problem, by Professor Mark Roe. Before we get started, please take this time to silence your cell phones and any other device that you have that might make noise. Thank you very much. So we're joined today by Professor Mark Roe and panelists Jesse Fried and Holger Spamann. Mark Roe is the David Berg Professor of Law at Harvard Law School, where he teaches corporate law and corporate bankruptcy. Holger Spamann is the Lawrence R. Grove Professor of Law at Harvard Law School, where he teaches corporate law and corporate finance. His research focuses on the law and economics of corporate governance and financial markets, judicial behavior, and comparative law. Jesse Fried is the Dane Professor of Law at Harvard Law School. Before joining the Harvard faculty in 2009, Fried was a professor of law and faculty co-director of the Berkeley Center for Law, Business, and the Economy at the University of California, Berkeley. So I'll now turn it over to our speakers for discussion, after which we'll have time for an audience Q&A.
So thank you, Leah, for the introduction, and thank you for coming to the event. And I see people out there who helped make this book happen, so thank people who had material effect in making it happen, colleagues, students, staff. So, stock market short-termism. Most corporate law issues are really law issues that are for insiders and experts, in that there are very few corporate law issues that burst out of the Delaware Chancery Court or the SEC to get the attention of general media, United States senators, occasionally presidential candidates. There are a few issues that do burst out. In recent years, corporate social responsibility is one of maybe the big issue that gets general media and general political attention. One of the other issues that over the decades has regularly gotten generalized attention is the belief that stock markets, because they're excessively short-term, are doing significant damage to the economy. The issue rises and falls, and in the last few years, its most significant public manifestation is its interconnection with corporate social responsibility, which is what I want to talk about after just giving a brief overview of the book. So it's one of the issues that gets media attention, stock market short-termism. It gets political attention also. So here's Joe Biden talking about stock market short-termism, and he says short-termism, and his notion of short-termism is rather precise and accurate. The notion that companies forego long-run investment to boost near-term stock price. It's not just a problem. It's not just something that we ought to use to fine-tune the system, but he says it's one of the greatest threats to America's enduring prosperity. So in perception, it's a deep and serious problem. And then again, on the verge of being elected president, trying to examine the forces that are negatively affecting employees across the economy, Biden points to two big institutional features, one of which is the way Wall Street, the stock market, forces business leaders to focus obsessively on the short run. And then over in Europe, well, it's maybe worldwide, the World Economic Forum. The people in Davos meet every year, elite business interests and elite political leaders, and there's regularly a session and an exhortation along the lines that's just briefly quoted and summarized here, usually put in place by the organizer of the event, Klaus Schwab, who thinks that there's short-termism from the stock market is a deeply fundamental problem holding us all back. And here's the cost. The finance world's short-termism will destroy our communities, economies, and the planet. This looks like serious stuff. The European Union in the last couple of years has had a sustainable corporate governance project seeking to remake significant parts of corporate governance with short-termism in mind. And the syllogism is really basic. Its sustainability is long-term. Stock market trading is short-term. these guys can't have a time horizon that goes beyond the closing bell that day. And if we want sustainable results, we've got to make the stock market long-term to produce those sustainable results. So, the book, just a couple of words on each section. What is stock market short-termism, which I want to talk about in a little bit more detail, the interaction with corporate social responsibility. What does the evidence tell us? So, one part is looking at the evidence, and the evidence for a subject for which the public profile is quite certain that we've got a problem, and it's only a question of how deep a problem. The evidence is actually quite mixed. So of the serious studies on the subject, about half of them say we're looking for stock market short-termism and a negative impact in a place we should find it, and we're not finding it. The other half say we're looking, usually for events around the quarterly report, and they conclude we're finding something. So half and half. Of the ones that find something, if you dig down, and I hope I've done this, or I sought to do this in the book, if you dig down into the tables, what you usually find, actually, what you find in every one of the major studies, that the effect is actually kind of small, maybe very, very small. And the consequence is that if you're trying to distill not from the public sensibility, but from the hard evidence that's available, I think the distillation would be, we probably have a small problem, but in a world or a country where we've got lots of big problems, this ought to be far down the list of things in which we're going to invest a lot of resources to deal with. Third section, cures and costs. A fair number of the cures, the analysis I end up coming up with, are not going to really resolve the problem. They're going to cost something, disrupting the mechanisms of corporate governance, general operations, and we ought to be confident that we've got a costly problem before we start dealing with costly solutions. If the reader is with me through part 3, then the question arises, if it doesn't seem to be a big problem, why is there so much attention over the decades to stock market short-termism? And the explanations, kind of speculative compared to the other sections of the book, but the speculative explanations are, there are interests who do better if stock market short-termism is seen to be a big problem, and it helps people, well, it helps people deal with some of the disruptions of modern life. So if things are moving very fast in our lives, particularly our work lives, and disorienting people inside large firms, you can imagine that looking at stock market short-termism could be a relief. So just one example of technology, it took about 3/4 of a century before half the households in the United States had a telephone, 14 years before people had a cell phone. Things just move faster today than they did 50 or 100 years ago. And if we're working for a firm with publicly traded stock, and something happens that disorients us, we acquire really useful skills before we're 30 years old, and before we're 35 years old, something has happened to the firm or technology that makes those skills redundant and not useful. Most of us who are well-adjusted just figure we've got to pick up another set of skills, or morph our current skills into something that's useful. Some people are going to say that it's the stock market that disrupted the firm as opposed to technology and the like that disrupted the firm. So let me talk about, in next 5-6 minutes, about stock market short-termism and its extent. So stock market short-termism, it's the firm deciding, presumably under the pressure of stockholders, that it needs to return cash now to its stockholders, even though it has a good use for the cash. A profit dollar today is worth much more than a profit dollar a few years hence. And this is what Joe Biden said was the problem of stock market short-termism, and if true, or to the extent true, this is true stock market short-termism. There's this other set of problems in society that are regularly attributed to stock market short-termism in the media, journalists, United States senators, and these are really properly analyzed as social problems, externalities, and not things that derive from the time horizon of the stock market. They might derive from the selfishness and incentives of managers and stockholders, but not from their time horizons. And let me give you a few for instances. So a half dozen features. The interaction between true time horizon problems and social problems that often seem to be due to a misshapen time horizon, but really come out of externality or other problems. There's some overlap. Not enough time to talk about the overlap, but there's some overlap. It's rather thin. The disjunction is much broader. So let's go through a few of these. So failing to invest, which is the thing that Biden focused on. If a firm fails to invest today in an investment that would provide jobs and a good return, and they fail to invest solely or primarily because the stock market is saying we need money now, not returns 5 years from now, this would be true stock market short-termism. I'm not going to talk about it right now here, but in the book the question is this really happening? It doesn't seem to be happening, but there's a belief that it's happening. Closely related, there's a belief that R&D is declining in large firms in the United States or not moving as deeply and widely as it should. If true, this would be stock market short-termism. If the stock market is killing viable R&D projects, this will damage the firm over the long run and damage the economy over the long run. The other one that comes up on a regular basis is firms are killing themselves by draining cash out of the firm in stock buybacks such that they become crippled or less capable of operating over the future. Jesse's done a lot of significant work on this over the last few years, and maybe we'll talk about it in a couple of minutes. Now, contrast that with these other things. Damaging the environment and the planet, which is frequently laid at the doorstep of stock market short-termism. It may be properly laid at the doorstep of the stock market and the incentives to do selfish things that externalize costs onto the rest of the economy, but it's not primarily due to a time horizon problem. So a firm that pollutes, it would be a time horizon problem if the firm pollutes and then it catches up to the firm 6 years later when the Environmental Protection Agency figures it out, sues, and puts the firm in significant distress. But if the firm pollutes and gets away with it and it never catches up with the firm, it's not a time horizon problem, it's an externality problem. And it's the same thing with climate catastrophe. If the firm pollutes but is, in ways, puts hydrocarbons out into the atmosphere in ways that are damaging, but does not itself pay for the hydrocarbons it puts out into the atmosphere or sells to the rest of us, it's not primarily a time horizon problem of the firm. It's a time horizon problem of society that we can't get our grips on it, but it's not a time horizon problem of the firm and the stock market itself. Stakeholders as well. It's a similar sort of thing. The notion is frequently that if firms were long-term, they would treat stakeholders better. And this requires that mistreatment today leads to costs later on. But if those costs never arrive, it's not a time horizon problem. The last that I mentioned is after the financial crisis of 2009, there was a widespread view that expressed, among others, by the Secretary of Treasury, Timothy Geithner, that a significant contributor to the financial crisis was coming from banks' short-term orientation. And while possible, there is this intersection. For the most part, that's probably false, in that the banks, the idea would be the banks were taking profitable decisions now that were going to be very costly later on. They were costly later on, but they were mostly costly to the people who lost jobs, lost their savings, lost their houses because the mortgages were foreclosed upon. And for some of the banks, they paid a price later on. For some of the banks, there was no cost or no deep crippling cost in the short run and the long run, in that some of the most substantial banks that were in this picture were bailed out and didn't pay the price for their misactions either in the short run or in the long run. The consequence then is things that are really social problems that are not primarily coming from stock market short-termism, that are really externalities, are conflated with the time horizon problem. And stock market short-termism seems much bigger than it is because the stuff on the right is seen as stock market short-termism, and they're really coming from the corporations, businesses' capacity to externalize costs. What are the consequences? Well, I'll skip over this slide. Consequences are misunderstand how the world works for people in academia. That's important. But there are consequences in the real world in decision making. So short-termism problems seem much bigger than they really are because we're including a lot of things that are really important and thinking that they're due to stock market short-termism. And there's a belief among some policymakers that we can solve the problems of climate change or mistreatment of stakeholders by making the firm a longer run operation. And that may, I believe does, make people more willing, policymakers more willing to undertake things, cures of the time horizon problem, in the belief that they're not just tinkering with the corporation, but they're doing their share to stave off climate catastrophe, environmental disaster, and the like. But it's unlikely that they're going to help. Okay, so thank you for listening to this, and that's what this book is about. Jesse.
So I want to first say that I'm really delighted to be here to celebrate Mark's wonderful and important book, and to be here on this panel with my friends and colleagues, Mark and Holger. So I'm going to talk about one aspect of the book that I've contributed some research to, and that's share buybacks. And I hope through my presentation that you'll get a sense of the short-termism hysteria that has gripped parts of our country. So it all started with Harvard, and in some sense it's Harvard's fault, but it's the business school, not the law school. In 2014, the Harvard Business Review published an article by a guy named William Lazonick, where he basically laid all of the economic and social problems in the country on stock buybacks. Stock buybacks are draining companies of cash. They can't invest. They can't pay employees. This article was very well received initially. It got a McKinsey award for being like the best article in the Harvard Business Review. And then this theme went viral. It was picked up by think tanks, asset managers like Larry Fink, corporate lawyers like Marty Lipton. Biden, in his Wall Street Journal piece in 2016 that Mark alluded to, took the approach from this article to make his op-ed, and even some economists started to harp on there being too many buybacks and dividends from companies. Marty Lipton in 2015 gloated because for 40 years, he's been arguing that companies are subject to short-termist pressures, and after this article came out, he said, finally we have proof look at all the dividends and repurchases that are going out. They're preventing companies from investing for the long term. Lozanic is one of the most successful policy entrepreneurs I've ever come to be aware of or met in my lifetime. He went to Capitol Hill and he convinced the staff of many leading Democratic senators and Congress people that the way to cure the ills of this country was through sharply regulating or eliminating stock buybacks. So there were literally over a dozen bills introduced to regulate stock buybacks. One by Chuck Schumer and Tammy Baldwin would rein in buybacks by basically giving the SEC authority over whether a company to do a buyback. Tammy Baldwin and our former colleague Liz Warren went further with a bill in 2018 that would ban all open market repurchases. So Charlie Wang and I, actually it's mostly Charlie since he's the data cruncher guy, went back and we looked at the data and we found that the numbers that Lozanic was reporting were correct. If you look at shareholder payouts over any given period, you add up buybacks and dividends, it's a massive percentage of total net income. This figure shows with the blue series total payouts and the gray in the background is total net income. But these figures are very misleading because, first of all, most stock buybacks are offset by equity issuances where capital flows from shareholders to companies, moving in the exact opposite direction of share repurchase and dividends. If you look at investment by public companies, it's at record or near record highs. Cash balances in public firms are at record highs. And firms that are public can always raise more cash by issuing equity. That's why they go public in the first place, so it's easy for them to raise additional capital. The other thing that people like Lozanic miss is that money that flows out of big publicly traded companies finds its way into the non-listed company sector, which basically drives half of our economy, firms that are backed by VC funds and private equity funds. So we started looking carefully at the data and trying to measure equity issuances, which turned out to not be so simple. Equity issuances basically fall into two categories. There are direct equity issuances to shareholders where the company sells stock to shareholders and you can see the cash showing up on the balance sheet of the company. And there are various ways of doing that. Most equity issuances, however, are indirect. The biggest type of equity issuance is through employee stock options. So basically the company gives stock to an employee. The employee then sells the stock on the market to a public shareholder, pockets the cash. That is economically equivalent to the company going and selling stock to shareholders and giving cash to the employee, something that a lot of people have missed. So if you look at equity issuances, which this figure captures, it's the orange series, you can see that equity issuances are fairly close to repurchases, which is the blue series, and they exceed dividends. If you look at payouts versus net shareholder payouts, and Lozanic is looking at payouts, dividends, and repurchases. Net shareholder payouts are dividends and repurchases minus equity issuances. You see that the net shareholder payouts, which actually captures how much money is flowing to shareholders, is much lower. Instead of being like 95% of net income, it's like 30% of net income. That means that there's a lot less cash remaining in companies than would be implied by Lozanic's figures. We also looked at investment levels by public companies. This figure does not show investment levels. Investment levels were going up over time because the economy was growing, public companies were growing. This figure shows the propensity to invest out of every marginal dollar of revenue. The dark blue series is CapEx and R&D over revenue, which is total investment. It peaked around the time of the dot-com bubble, then it dropped dramatically as the bubble burst and we went into a recession. Then it started increasing over time. It's still not back to, at least by 2016, wasn't back to where it was at its peak, but it's climbing back. It doesn't show any sign of distress. And as Mark points out in his book, if you look across the world, CapEx levels generally are declining, probably because the world is changing very quickly and it's hard to figure out what capital assets are going to generate value over the next 10 years. If you look at R&D over revenue, which is probably more important in a modern economy, you see it climbing. So not only is R&D climbing in absolute terms, R&D expenditures climbing, but the propensity to invest out of revenue. So you could say, well, maybe it would be even higher if there were more cash. But if you look at cash balances in public companies, which is the dark series, it's just going up over time. It starts in 2007 at, I think, I don't know, 3 trillion, and it ends up at like 5 trillion by the end of the decade, and it kept on climbing. So these companies are sitting on plenty of cash. To circle back to something I said very quickly at the beginning, these figures that I just presented to you sort of understate the capacity of public companies to engage in long-term investment if it makes sense, because firms can always issue more equity if there are profitable opportunities. The fact that they've paid out a lot of cash in the past does not prevent them from raising money in the future via sales of equity. So even if a particular firm doesn't have much cash, it can just sell more equity. And importantly, our economy is not sort of bounded by the S&P 500. The S&P 500 may represent 40% of our economy. It's the most mature firms, the biggest firms. Money that comes out from those firms goes into smaller publicly traded companies and also goes into companies that are not yet public or may never be public, but which are an important source of innovation and employment in our economy. So that's what I wanted to add to the panel. Thank you.
Thank you, Jesse. Thank you, Mark. Great honor to be on this panel. Mark was my SJD advisor, so it's a special pleasure to be here, allowed to comment on his book. So I want to start by, on the one hand, saying that short-termism is maybe more real than Mark in his presentation led on, but also that it's not even a problem. So Mark said it's a small problem. I think it's not a problem, at least not in the way that people usually define what a problem is. So let me start by giving you a well-known example of short-termism. It's like everybody knows about this in accounting and in business, channel stuffing. End of the fiscal year, everybody tries to push through more sales, giving rebates to the clients. Why? Because that boosts sales numbers. This year boosts revenue, may boost profit. Of course, this is costly in the long run here being next year, because the clients who've just bought your product at a discount now, well, they're not going to buy next month in your new fiscal year at the normal price. They are going to buy less next year, so this is in the long run, this is harmful. And it's very well known that this happens. It's been empirically documented. Practitioners know about this. This is a standard problem. That is short-termism. But it is short-termism that we understand to be, first of all, not limited to public companies. This can even happen in private companies. Does happen in private companies because they also have investors. They also have employees who are trying to boost their sales numbers now. When they have a superior who's going to check how much they sold. So this is a problem that transcends the public firm. And moreover, the interesting thing about this sort of behavior is it is a side effect of having an incentive system in the first place. So give you another example here. There's another form of short-termism that some people worry a lot about, which is exams. Exams, university, but also mostly, I think, in K-12 education. Learning for exams is short-termist, or at least it can be, right? Because it's not the right moment now to focus on like cramming for an exam. You'd be better off, the students would be better served if they had a long-term learning plan And that's why some schools, of course, forego exams altogether. Montessori schools don't do exams, okay, there's a debate about this. But to the extent you have exams, why do you do it? Because you think that if you didn't have any exams, there wouldn't be any accountability at all. There wouldn't be accountability for the students, or perhaps you're more worried about the teachers. If you have ideal teachers, maybe they can design the great teaching plan. You don't need to have exams, but if you have real-world teachers, then maybe you have to watch what they're doing. And how do you do it? You send the students to tests. The teachers can then teach to the test. We know this problem, it is a problem, but everything considered, that at least so many in most institutions think that that's the lesser of the two evils, the other evil being not having any accountability whatsoever. So the short-termism, the kind of short-termism that I've discussed, there's many more examples of CEO behavior trying to get the numbers up this quarter just so that they live to fight another day next quarter, or to get their bonus this year or whatever. We know this is real short-termism, and some of it is very specific to stock markets because it's stock-based pay that the managers are trying to influence, but it is a trade-off. That's why I don't want to call it a problem. It's a side effect. Now, always in medication or in compensation design, you want to limit the side effects. That's, of course, the goal, but as long as you can't have the good without the negative side effect, you'll accept the negative side effect. And I don't think you generally call that a problem, or at least I wouldn't call that a problem. I think as a first approximation, I like to tell my students, some of whom are here, you just look out into the world of the stock market, and you look at the largest US companies. You look at Amazon. I'm not sure it has paid a dividend now. It certainly didn't pay a dividend for the first, 20 years of its existence. It has grown tremendously, apparently without problems with the stock market. Google, all of these tech companies, they invested most of their cash for the first, 10, 15 years of their public existence. So at some level, it can't be the case that we have a big short-termist problem there. And focusing on the small side effects would be like missing the forest for the trees. Two more things I wanted to briefly touch upon. I guess to underline the importance of Mark's work. About 3 years ago, the European Union came out with a report by, I won't even mention who, it's too embarrassing for the target. It was a report that was purporting to document the nefarious consequences of short-termism in the stock market, and then proposing very, very, very far-reaching reforms to corporate law in the European Union. Mark, Jesse, Charlie, and I got together and wrote a critique, which I don't know if it was our contribution, but apparently this report was shelved, and the European Union actually changed its plans, we would say, for the better, because the new reforms, they let go of this hoax of short-termism to at least a large extent and focus on externalities instead, which is at least the right direction, even though one may quibble with details. And the last thing I will say is that Mark only touched upon it very briefly in citing Marty Lipton's reaction to the Lazonic, or Jesse, to the Lazonic article. I suspect that Marty Lipton is behind a lot of this stuff. So, Jesse was blaming the business school. I'm not sure. I'm blaming NYU Law School, because that's where Marty Lipton went to law school. And of course, he's a fantastic lawyer, and to the extent he has been successful in pushing this idea of short-termism since 1979, power to him as a lawyer. But maybe it's also interesting to know that that's where a lot of this thinking originates. The last sentence I will say is that Wachtell Lipton is indeed the sponsor or the author of the World Economic Forum's statement on corporate purpose, which also, of course, alludes to short-termism, and also the sponsor of the British Academy's statement on corporate purpose, which also alludes to short-termism. So Marty Lipton seems to have his fingers in a lot of this.
Great, thank you guys so much. So we're now going to move to the audience Q&A portion of our talk today. We have 2 library staff members here. If you have a question for any of the panelists, please raise your hand and someone will come find you with the microphone to ask your question.
Professor Fried, I'm wondering, when you're talking about the cash that might be leaving the larger companies and then flowing into the private markets, if we're able to, or if you have like empirical evidence of that, or to what extent is happening, or the effects of that cash flow over time, or if we're just assuming that the issuer buys back stock and then the investor is also invested in other organizations and expands those investments. Like, is it an assumption, or are we able to observe that?
Mark's going to answer that question, which is great, because the answer I would give you is not the one I would hope to be able to give you.
Well, why don't you give your answer?
The answer is we don't know exactly where money goes because we can't trace it. I don't have the technology, and neither does Charlie. So what we do know is that there are many investors, in fact most investors, who invest both in non-traded companies, private companies, and in public companies, and they're constantly rebalancing their portfolios, and they're getting cash inflows from both and reinvesting them. So, unless this money is consumed, and some of it obviously will be because people are saving for retirement, consuming, the money coming out from companies that are mature is going to find its way, via hedge funds, private equity funds, venture capital funds, and the institutional investors who invest in them to these other companies.
That's approximately the answer that I would give. One of the things that I did that's related is look at outflows from the S&P 500, and it's outflows of equity and outflows related to taking on more long-term debt or paying off long-term debt. And it turns out that the total outflow from the S&P 500 approximates the inflow to the non-S&P 500. Now, as Jesse says, you can't trace the dollars. The money flowing in could be coming from some other part of the universe, but when you look at the numbers, it doesn't look like something to be deeply, deeply worried about. One thing that I would mention that came to mind when Holger and Jesse were talking about research and development, was one of the things that people are most worried about when talking about stock market short-termism. And in the interest of time, I didn't provide this figure, but to me, it's an interesting and compelling figure. So if you look at R&D spending over time in public companies, you find that it's going up, and it's going up faster than the economy is growing. Maybe with a different set of arrangements, we go up even faster. But then you take a look and you put on the same graph government public spending on R&D, and a significant amount of American well-being has been coming from, over the decades, breakthroughs that were funded by the United States. Over the last approximately 20 years, government backing for, if I could get to it, I would get, well, I don't think I can get to it fast enough. Government backing for R&D in the United States has been declining, and it's been declining significantly. Maybe some of the statutes passed over the summer will reverse it, but to fit with the title of the book, Missing the Target, if we're truly focused on R&D spending is too little, and we need better results from research and development. Maybe we can get it from corporate America, but if you're looking for the first best thing to do, if both corporate R&D and government-backed R&D have been significant, and we've seen over time that corporate R&D is growing faster than the economy, but government R&D is noticeably slipping, particularly after the financial crisis when spending was sequestered. The first thing to look at is why is it declining, and is that the first place that Congress should be looking at to refund and revive? See if that works before we start fiddling with corporate governance.
May I add one thing there? I was already tempted to add that to Jesse's presentation. So the fact that so much of investment writ large today is in R&D also has a very important consequence for interpreting the data, because R&D isn't capitalized. And what that means is that in your earnings, when you're looking at earnings are what the company made net of R&D. So you could have a company that pays out all of its earnings and yet is heavily investing. Why? Because all of that investment would already be subtracted out from the earnings. They wouldn't, whatever you see in earnings is net of R&D, and then you pay that out. Fine, pay out all of it, but you have already done a lot of R&D. That's just, if you're looking at earnings, you're looking in the wrong place.
One aspect of public R&D spending, if you look around the world, public R&D spending among major countries is rising everywhere but the United States.
So it seems to me that a way to invest in innovation, research and development these days is to acquire private companies that do that, right? So is there any evidence that there's a division of labor where maybe public companies, actually they are investing in R&D, but they're also probably buying smaller companies, private companies that are doing much of the innovation, and so in any case that would be that wouldn't be seen probably in the R&D numbers, at least the paper I remember. Another quick question I have, another definition, potential definition of a short-termism, which is not the standard one, could be just that we've become more like our hurdle rates for investments have become too high, right? So one way to look to interpret short-termism could be that we are less willing to invest in projects where our NPV hurdle rate has become too high for psychological reasons, maybe for cultural reasons. Is there any evidence that internal hurdle rates to select investments have gone higher?
Okay, on the first question, stock market, R&D, and private companies. The way I interpret this book is actually private companies. Pharma is well known for this. Small private companies, recent PhDs in the relevant things, set up a small company, do the research. If they succeed, they're frequently then bought up by Pfizer or other major pharmaceutical companies. When we think about this fully, it's functionally the stock market financing R&D, because what happens is the PhD does it with private capital, but the payoff is coming when the company is purchased, sometimes in cash from Pfizer, that gets the cash from the stock market, or sometimes it's paid off, bought in stock from Pfizer, that buys the company that does the pharmaceutical work. Since on the second question, so that's the first thing, is that private companies that end up being acquired, particularly if they're acquired and the consideration is stock, but sometimes even if it's not stock, are functionally being financed by the stock market. And nobody includes those R&D numbers in R&D that's being done by public companies. All the R&D numbers that show a steady rise and a rise faster than GDP is rising comes from the actual direct spending of public companies. But using your metric, it would be even higher. Hurdle rate for investment. I don't know that anybody's looked at whether the hurdle rates have been changing and in a way that's pernicious. That it could be changing, but it could be changing because things are moving so fast that we don't know whether this investment will really be cutting-edge technology 5 years from now that will be worth having. It may be displaced. So if technology is moving so fast that we can only be confident that the technology will be good for 3 years, then it would be appropriate for the investment manager to say, we've got to see what this is going to return in 3 years. In terms of hard investment, CapEx instead of CapEx plus R&D, so the more modern view, which dovetails some of the points that Holger and Jesse made, the more modern view of looking at capital investment is to add capital expenditures in hard assets to expenditures in R&D. That in the modern world of technology, it's the two together that are investments. In terms of investment in hard assets, traditional CapEx, there's no doubt that investment in CapEx in the United States has been going down over the last 30 or 40 years. But compare this, the decline in the United States, to capital expenditure investments in the rest of the developed world. Countries that, for the most part, with the exception of the United Kingdom, depend less on the stock market than the United States. Turns out that capital expenditures in hard assets are declining faster everywhere else in the world compared to the United States. It's not this much, but it's this much, suggesting that the stock market is not the principal cause behind the decline, but changes in economic arrangements, changes in the relative importance of hard assets, changes in where hard assets and manufacturing are used. There's a significant amount of manufacturing has moved over the last 30 years to East Asia. And if companies, both in Europe, where the stock market is less important than the United States, and the United States are spending less in hard capital assets, it becomes more difficult to say it's the stock markets that's the inducement as opposed to some other explanation, some other target.
Yeah.
Kobe?
Yeah, thank you very much. I'd like to connect it to your earlier work on political economy and what was going on in the 80s. So it seems like we have two coalitions here, right? The politicians that for their own reason push on that, and then corporate managers and their advisors who push on it for their own interest, and they create some sort of coalition. But to what extent you think that the politicians will move to the next stage and really push forward? I mean, this is just a way for them to collect support, or are they really going to push forward for actual reforms? And maybe what Lipton is trying to achieve is even more genius than what we think. It just, temper a little bit the pressures around distribution of dividends and everything, but it doesn't want that it will move to the next stage of actually blocking it. And to what extent you think, providing, like setting the record right on the empirical evidence actually change on the political level and what people think about it, the manipulation that can be done?
So that's a fair question. It's maybe a fair question for what we do generally in academia. If truth is important, then it's important to get to truth. But if we're in a post-truth polity, it may be important for us, and sometimes we just have to recognize that we don't have the kind of influence we think we richly deserve in real-world policy making. I'm not completely pessimistic. I'm substantially pessimistic, but not completely pessimistic in this way, is that I think truth is still a factor in political decision making. It's not the central thing that goes into political decision making, but it's a factor, and there are some politicians for which we want to get votes, but if we really think it's a bad thing and we're not going to lose too many votes, there are some politicians, I believe, I hope, still out there who will take this into account. Holger alluded to our effort to persuade the European Union that they were going off on the wrong angle, and they changed their angle, and we were told by some of the insiders that what we wrote had influence. Maybe they were being nice to us, but there certainly was a change. But some of my pessimism on some of these things is not just vis-a-vis the corporation. It's, I think, society is short-term in some way. So just when I was on my rowing machine in the morning listening to the news, I'm listening to the discussion that with gas prices at around, I forget what it is, $3.70 per gallon, that the Democrats are facing a significant chance of doing poorly in the midterm elections. And this made me, the pricing, it made me upset in a couple of different dimensions, but the dimension that's most relevant here is the social cost of gasoline is on the order of $5, $6, $7 per barrel. And if a political party is thinking, and another political party is thinking we can use this to our advantage, that gasoline is too high at $3.60, $3.80 per gallon, this is a bad direction for dealing with climate change and our overuse of hydrocarbons. The price of gasoline per gallon should be $4, $5, $6, maybe $7 per gallon, and the polity won't tolerate it. And this is a source of why can't we do this? We seem not to be able to do this.
Okay, we've run out of time for questions, but let's give another round of applause for our speakers. Thank you very much for a fascinating conversation and your insight. You can get a copy of the print book from the Harvard Coop at the table outside, or of course you can always check it out from the Harvard Law School Library.